Right, I'm going to show you how I made 10% last month, just under it actually. I'll show my full trade history and how I did it without even opening my charts. So let's get into it. So here you go, as full transparency, I'm going to show you right now that on March the 11th, this is American dates, I made a 10k demo account just to show with a small account what you sort of can make and how I've done it without even opening my chart. So I'm just going to scroll through and show you every trade I've taken. So let's go. You can see a lot of $10, $10, $10, and I'll get into why they're those $10 and $11 when we get to the end. So there you go, that's the full month. So now it's the 4th, 15th, so it's about a month and 4 days. And we did $971, which is just under 10% on a 10k account. So obviously if it were like a $100,000 account, you'd have made $9,000 last month. So I'll get into how I sort of traded this and what I look for entries and exits and what my bot does to automate this. So how did I automate my trading last month? How did I make almost 10% without even opening my charts? It's simply put, I've got a bot that I've made that automatically runs for me, and it's had a pretty good month last month. 10% is a good month. So let's just have a look at how it works. So it's dollar cost averaging in. It's going to have these single positions that go straight to profit. Like here, we had a short. Here, we had a short. Here, a short. Here we added a short, price moved against us a decent amount. We didn't get stopped out, but what we did was we added to that losing trade. So we got one short here and one short here. Both trades eventually closing out here to a profit target that I have set in the bot. And then we just have a few more single trades as time progresses. And at the moment, I can show you an example right now of a position that's moving against me. So I've added a short here because of my confluences. My confluences have lined up on a higher time frame as well as a lower time frame. So we have a short down here at the bottom, and then we also have a second short right here. So one short, two short. This orange line, which you might be wondering, is this is my average price or my break even price. So my first position was right here. My average price, when this one was the only trade open, would be here. Price has moved against me. I've added a second trade with a slightly larger position size. So we've got 0.02. This one is hiding. Let me zoom in. And this one is a 0.03. So it's a slight increase in the lot size. So by slightly increasing the lot size, we actually bring our average price closer to where price is currently. So at the moment, if we did the same lot size and it was spaced, obviously whatever it's spaced, it's going to be right in the middle of those two. But since I've increased the lot size ever so slightly, it's brought the average price slightly closer. So as you can see, we almost got break even a few times, but we're going to target a different profit target because we're in a multi-trade. So single trades like these ones here will have a different profit target to the multi-trade, or however you want to set it up in the bot. Bear with my slow VPS. So this is running on a VPS, meaning a remote desktop. I do this so I can have my bot running 24/7 and just trade even while I'm not looking at my computer. So this 10% month I did was without even looking at my computer, which is kind of crazy. So let's have a look at some of the settings. So what we have here is our risk settings. So I've risked 0.25% of my account balance over one average daily range of movement. You can choose what average daily range you want to use towards the bottom. We have average daily range settings. So this is what we use to calculate your risk and pretty much just your lot size. Essentially, the concept is if you were to enter a long, because you see price has had a very strong move towards the downside. You're expecting price to have some sort of pullback for the banks and institutions to take their profits. So as price pushes down sharply, we're expecting some sort of pullback to get out. So as price is stretched down and we start to see the buyers coming into the market by using a moving average, for example, or looking for a break of structure towards the upside, we know that price could be having that snapback that we're expecting. So price starts coming down. We're expecting the snap back up. So what we do is we start averaging into our position because we're expecting this move to happen that historically happens over and over again. So for example, we add our first long position here. Price continues to move against us. Now we add another position size here. Price continues to move against us. So we add another buy. So we add into our losing trades. Our average price would be in the middle of these positions, right here. Not here, not here, but here in the middle. If we slightly increase the lot size, not martingale, you're not doubling your lot size, but if you're slightly increasing it a little bit each time, our average price will actually become closer to where price is at the moment, which is down here. So we have slightly bigger lot sizes from the first position up, and price snaps back. Our average price with the larger lot size would actually be all the way down here, very close to where our position is. We didn't get stopped out from either of these positions as price moved against us because we're waiting for our positions to be in profit. It's that simple. You wait for your positions to be in profit. It sounds simple, and it is, but there are things you've got to do in order to make money with this. And the first thing is using the correct position sizing. If you do a massive position on your first order, you're probably going to blow your account by the time you reach the bottom. So first things first, you have to risk the right amount. Another important thing, space your trades out nicely. Not too far and not too close. So you need to find sort of your sweet spot, and you can find this through back testing. So you can't risk too much. You have to risk the right amount first of all. Second of all, you need to have the right spacing between your trades. Also, you could say for the third thing, your multiplier, you don't want to multiply it too much. If you multiply it by 2 every time, you're probably going to blow your account by the time you get to the bottom. So you can't multiply it too much either. And as a fourth thing, if you're in multiple trades that are all USD crosses like Euro USD or USD CAD, if you're in too many US dollar crosses and you're positioning in and dollar cost averaging in, if they go very badly against you, you could blow your account as well because you're trading too much of the same currency. You're over leveraged, you're overexposed in one currency. So you got to spread your account out over currencies as well as do the previous 3 things that I said. Another setting which I have in my bot, which also makes sense, is you're not just going to sit in these positions if they go very hard against you. You're going to have to manage your risk as price moves. So you can't just sit in a position, cross your fingers and your toes, and wait for price to come back into your price. If price does move against you very hard, you have these settings here. So if one position goes into 1% of drawdown, you're going to close off 1/3 of that position. So what that's going to do is, say you're in 3 positions, and by the time price reaches the bottom here, this position is in 1% of drawdown. So for example's sake, let's say they're all the same lot size. So your average price right now is here. This position right here goes into 1% of drawdown. So you're going to close off 1/3 of this position here. What does that do? You have a smaller lot size up the top and then bigger lot sizes at the bottom. So that's also going to bring your average price closer to where price is currently. So when we do have that snapback we're expecting, you can get into break even and then profit even quicker. Okay, so that is the gist of it. But how do we know when the market is stretched far in one direction and we're expecting that pullback. You can sort of choose which time frame you look at. Obviously, you need to look at a higher time frame, but you can mechanically see when price is extended by looking at the RSI. So if you just look back in history, you can see that when we're above the 70 or below the 30 levels over here on the side, you can see we're above, we come down. We're below, put a crosshair on. We're below, we come up. My head's in the way, hang on. So we're below, we come up. We're above, we come down. Almost touched it here, and then we come down. Below by here, above, you would have averaged in here and got out right here when you had that little pullback. Even though we didn't have a full retracement into this wide range bar right here, even though we just came back and tapped it, we still got out with a profit because our average price would have been so close to the top where it would have snapped back. So that's the first thing. We're mechanically seeing that price is stretched and is expecting a pullback by using the RSI. Now you can use different RSIs and you can use different time frames as well to look at. So if you might want to be a bit more risky, you might use the hour RSI and wait for 70-30s. That will give you a lot more entries than if you were to use the daily or the 4-hour chart. So now we've mechanically seen that price is stretched up by using the RSI. So now we jump down to the M15 and we wait for a moving average cross down for sells or up for buys. So over here for this example on EURUSD, at the moment on the daily chart, we're at almost 80 RSI. So we are extremely overbought and we are expecting a pullback down for these banks and institutions to take their profits. So let's look at the daily again. Look at this move we've had up. We need to have some sort of pullback for these banks and institutions to take profit. You can see it happening over and over again. So we go down, take profit, take profit, take profit, take profit, take profit, take. It just moves up and down. That's what it does, these Forex pairs. Don't try and trade this strategy with gold or indices, all right? With currencies, you do have these snapbacks. So right now, look how stretched up we are. We need some sort of pullback back down for these guys to take their profits. So we're waiting for that move. As you can see, I've started averaging in here with this orange bar. So when that does eventually pull back, I'll be sitting in profit and I'll be happy. So now we know it's mechanically stretched up by using the RSI. Over time, you'll be able to just look at charts. Like you can look at this and see, wow, it's moved up a fair bit. It's probably going to snap back. Anyways, so we use the RSI. The bot uses the RSI to automate it. So since it's overbought, once we have a moving average cross towards the downside, we know that the sellers are entering the market. So that's a good sort of position for us to enter a trade for a short. Now it'd be the opposite if the RSI was low and we have a moving average cross up. So now we just wait. We wait for it to come in profit. It's at a zone where it's very likely to come into our profit because it needs to come down. So if you saw at the start of the video, you would have seen that my take profits a lot of the time were about $10 on the dot. The reason they're a slight bit over is because my bot would have compensated for swap costs. So as you trade, as you hold trades over time, you either get charged or you get paid to hold positions. So just for EURUSD here, you can see that we'll be charged $10 every night we hold it if we have one standard lot open. And we'll actually get paid $2 if we short it. This is to do with the difference in a currency's interest rates. So the euro versus the US dollar. You get paid to hold it long. So what I do with my bot is I filter out these bad trades. I don't want to be positioning in or dollar cost averaging in a pair that has expensive swap costs, because if I get stuck in that position, it's going to cost me a lot of money to hold. I don't want that. So like I said before, the 3 key mechanics dollar cost averaging are that you scale in small and you let the market participants move your positions into profit when they're ready. So we're not using a hard stop loss, because we're just going to keep getting stopped out. The problem with stop losses is you're trying to time the market. You're trying to wait and get the perfect entry so that you don't get stopped out. If you dollar cost average, you don't have to time the market perfectly, and you can just wait for your positions to be in profit. So since historically we see that price just moves up and down, that's what it does, I have to wait until I see the rubber band or the market is stretched far in one direction before I even consider entering a position. So these squeezes, aka where price just keeps moving against you and keeps moving against you, you keep averaging in but it keeps moving against you, they happen. So every time you enter a position, you have to enter such a small amount that when it moves very, very far against you, you're not going to be hurting or worried about your account blowing, because you're in such a small position size. You saw just then, with a 10K account, my bot was doing 0.02 and 0.03 lots on that particular pair. So you're doing very small amounts, but you're banking small amounts every day. As you saw, $10, $10, $10, $10, it adds up. That's how I almost made 10% or $1,000 last month by using tiny position sizes. We're just waiting for price to go in profit. Alright, and that's the end of the video. I'm not going to go too much more in depth into how the bot works meticulously, but it's been profitable to me all year. So all of 2025, I'm still yet to have a losing month. If you do want to try it out yourself and use it in the back tester, there is a free demo on MQL4 Marketplace, which I'll leave a link in the description. And obviously, if you have any more questions, just message me on Discord. I'll leave a link in the description for that as well. So thanks for watching.